You already know the major reasons people fail at personal finance. I don't have to tell you credit card debt is bad. Or if you don't max out your company's retirement savings and start early enough, you won't reach your goals. And of course, you don't need to hear you need to spend less than you make, paying yourself first. In effect, you buying stuff is keeping you poor. You don't need to hear the obvious reasons people fail with money. You want to know where the little known potholes are in the road that'll blow your tire and cause you to wreck. Over and above the basics, you don't need to be confused by terminology that only bankers and investment gurus understand. You want someone to tell it to you straight. What do I need to avoid so I don't end up poor? And what do I need to buy to avoid financial failure? Did you know nearly 70% of Americans have less than $1,000 stashed away? There's reasons people don't have savings. Most of the time, these reasons can be avoided. I help young people learn how to work, earn, and save. I'm Dr. Jim Kay, and I have 4 personal finance books published, including Financial Wellness, Prepare for Retirement and the Unexpected, Become Financially Healthy, and Positively Change Your Life. I want you to learn the less common ways people fail with their finances. There are 3 little-known categories that people will screw up with their personal finances. Banks and mortgage companies want you to take out the largest loan possible so they can earn the most money off of you. Real estate agents want you to buy the most expensive house so they can earn the most commission from you. The debt to income ratio allowed by banks to buy a house is way too high. Banks will allow you to take on so much debt you'd hardly be able to afford to live, let alone enjoy a vacation. If you followed their advice, more than half of your take-home pay will be going to your house. A more manageable number is a quarter of your take-home pay goes towards your housing each month. If your combined take-home pay is $8,000, your rent or house payment can be $2,000. I did driver's ed for years. I would teach students how to drive. We would spend a total of 8 hours behind the wheel. I had one student whose parents wanted to meet me. So after we drove, I was dropping her off. I went to the door to introduce myself. She had a huge house. It was mostly brick with some wood accents. It looked brand new. I met the parents and they invited me inside. As I went in, I realized they had very little furniture. What they did have was what most people might have in a college apartment. A futon in the family room. No bar stools at the kitchen counter. The kitchen table, it looked like they got it at a garage sale with mismatched chairs. They had an expensive house, but furniture that didn't match the elegant home. Maybe that was their lifestyle, but more likely, they had a mortgage they could barely afford and not enough money to buy things they wanted, like furniture, vacations, or going out to eat. Most people want an expensive car. They want to seem successful. They justify the purchase by telling themselves they can't afford a car that breaks down. They can't deal with the financial stress of making repairs. But what they don't realize is the cost to own that newer car far exceeds any repairs they would need to keep an older and reliable model running. Buy a less expensive, reliable car for cash that you've saved up. Leave the unreliable and expensive cars to those who can afford them and the people who don't care about their finances. I had a friend named Ed. He did it right. He waited to buy a car until after college graduation. He never needed a car while at university because he could get public transportation. His friends could drive him, and his parents would pick him up at the end of the year. When he went into the work world, he needed a car to get to his new job. Even though he could have gotten a loan, He didn't. He bought a reliable used car for $7,000. Within a year, it needed a few repairs, but the $800 he spent was far less than a year's worth of car payments. Over the next 2 years, he saved up to buy another car. He sold his old one for $5,000. He used that money and the money in his car fund to buy a $12,000 used, reliable car. That one lasted years. During that time, Ed was able to save up. He was never ashamed of the car he drove. He focused more on his work and climbing the corporate ladder with the skills he was learning. He sold his car for about half of what he paid for it and used most of his car fund to buy a $33,000 car. Now, he was driving one of the nicest cars parked at work, and he never once had a car payment. We all like going out to eat. Well, if you don't, something's wrong with you. It's like taking a little vacation. Let someone else cater to you, feed you, clean up after you. But excessive spending at restaurants, shopping, and paying unnecessary convenience fees is a surefire way to wreck your finances. When we say fees, think of banking fees, credit card fees, and late fees. People get into a little financial situation, end up in a big financial dilemma because of the fees added to their mistake. Rachel, a friend of my wife's, couldn't make her rent payment. It was her fault. She spent too much that month shopping and eating out. Rachel went to a payday loan place. This is where you can get a short-term loan and pay it back when you're paid. She was expecting her next paycheck in 2 weeks, but rent was due on Tuesday. If she didn't pay rent on time, she would have to pay fees and risk having her and her son evicted. Her payday loan was enough for her to pay rent on time, but it came with fees and interest. After she got paid from work, she didn't realize she had to use that money to pay for other bills, like utilities. She didn't have enough money to pay back the payday loan. She asked if she could make a partial payment. The answer was no, but they could extend the loan, adding more fees to it for another 2 weeks. She had no other choice. This process went on for months. Her small loan to pay the rent was now in the thousands, and she saw no way out. Ultimately, she sold her son's video game console, all of his games, 2 old cell phones, the jewelry she inherited from her grandmother, 3 kitchen appliances, clothing, and a Gucci bag given to her as a gift. She paid back the loan, but at a cost. Among those who pay for streaming services but don't use them, respondents had an average of 1.65 entertainment subscriptions. Based on the cost of those services, these people waste an average of $347 per year on entertainment subscriptions they aren't using. Drop the subscriptions you don't use. Don't get into loans you have to pay back every month. Instead of buying furniture on credit, save up and buy it. Instead of taking out student loans, save, work, and go to a less expensive college near home. Don't get overwhelmed with monthly payments for entertainment or repaying debt. Sam was a girl who wanted to retire early. She knew to make her goal, she would need to streamline her expenses. She would have to live frugally. She would need to drop costs that weren't necessary to her survival or her ability to make money. She took the idea of reducing her monthly payments to the extreme. Sam moved into a basement apartment of this old lady's house. Her new place was within walking distance of work and the grocery store. There was a park nearby, too, where she'd exercise. She dropped the entertainment subscriptions. The landlord had Wi-Fi she could use, and she didn't use data on her phone. A basic call and text plan on her plain phone was less than $10 a month. Sam worked and saved. She kept her expenses low and had enough savings to retire within 9 years. If you get sick and rack up bills, or you can't work because of an injury, how much money do you have in reserves to pay the medical bills? How many months can you go without working? If you come down with an illness without medical insurance, you're looking at tens of thousands of dollars, up to millions for medical treatment. People who don't have adequate insurance and become ill have huge medical bills. Large enough, their finances are ruined for years, if not their entire life. One car accident, one illness can wreak havoc on your financial goals. If you get hurt and can no longer work, you'll wish you had long-term disability insurance. Imagine you having a good paying job. You have goals of traveling, buying a sporty car. One accident leaves you without the ability to work. Your goals are blasted out the window. You can't afford a sports car, let alone a van that'll accommodate your disability. It's a terrible story, and I wish I could have helped more than I did. In our neighborhood, we had a young family, Stan and Jen. We're married 5 years earlier, and they had a 3-year-old named Stacy. Stan had a job, and Jen stayed home with her daughter. Stan's work didn't offer health insurance, and the couple decided not to spend the $25,000 a year to get adequate coverage. They figured they were healthy enough. What they didn't figure was Stacy getting seriously ill with a respiratory system disease. The bill started small with doctor's visits and medicine. But when Stacy was hospitalized, the bills racked up quickly. Stacy pulled through, but the family was in debt for $55,000. The money you're earning out of college seems like a lot, but as the cost of living increases and you suddenly need a larger place and a nicer car, your income isn't enough to cover the costs. If you'd continued learning, educating yourself, and training for the next level at work, you could advance your career where you are or find another job. Those people who don't take the initiative to learn new skills and continue to be an asset to their employer lose their jobs. Stu was my buddy in college. He was always a bit lazy. I remember seeing him saunter to classes that had mandatory attendance. Otherwise, he would skip. Eventually, he graduated 6 years after he started. Stu got a job as an equipment service manager and was making $55,000 a year. Over the years, Stu never tried to learn new skills. He never tried to advance his career. 10 years after he graduated, he was fired. Times had changed. Equipment became more complicated and Stu never kept up with his training. Now, Stu was 34 years old and out of work guy with not enough skills to get a new job paying what he was used to. Stu finally did get a new job as a dispatcher, but was only making $33,000 a year. Those people who don't have 4 months of living expenses to deal with financial struggles end up going into debt to deal with their problems. When you have 4 months of living expenses saved up, you'll have the ability to pull money out of that savings to pay for emergencies. My Uncle Bill always taught me to have 4 months of emergency fund. He would say, take the amount of money you spend on necessities each month, multiply it by 4, and put that money away. Bill had a house, and he had to use his emergency fund a few times. One time, a tree branch fell and put a hole in his roof. Well, that was $1,500 repair. His wife caused a car accident, and her car was totaled. He had to pay the $1,000 deductible and come up with $5,000 to replace her car. He knew his hot water heater would need to be replaced, but he didn't figure he'd have to do it only after 8 years. He had to come up with $1,900 for that. He had other things come up, but the point is, instead of going into debt, Bill used his emergency fund and then replaced the money over time. It's costly to live on your own. Once you move out, expenses seem to crop out of nowhere. Not only do you need enough money to cover your first few months, but you also need some savings set aside for things you didn't think about. My daughter moved out while she was still in college. We talked about the things she would need to buy, and she had enough savings to afford them. She also had enough savings to pay for food, her cell phone bill, and necessities for a month. She had a job and figured she could afford her bills on the money she was making. She, along with some friends, moved into a house. It wasn't all that pretty, but it was cheap. Within a month of moving out, she and her roommates realized that they're responsible for yard care. None of them had a lawnmower, nor the desire to spend 2 hours every other week mowing, edging, and blowing. They had to hire someone to take care of it. They found a teenager in the neighborhood who charged $50 each time. So there was another $100 a month she and her roommates had to come up with. Soon after she moved out, she got lonely. Even though she had roommates, she wanted a cat. The cost of adoption, vet bills, and setup was $250. The expenses didn't stop there. In the first year, she spent over $400 on her pet. She was also under a lot of stress. She worked a lot and went to school. She didn't have much time to go grocery shopping or cook at home, so she ate out a lot. Eating out a few times a week cost her $50 more a week compared to eating at home. If my daughter had more savings, she wouldn't have been so stressed. If she thought about all the financial implications of moving out, she may have chosen to live with us a bit longer. Sure, you might encounter someone who rips you off. You might get involved in a business deal where you're taken advantage of. You might even have a family member who's jealous of your good fortune and try to take it away. But when it comes to people causing you financial ruin, there is nothing as costly as divorce. Divorce is expensive. Even if you don't have to pay lawyers, the financial impact of getting separated can be devastating to your finances. Where you used to have two incomes to afford a house, now you have one income each and need to find suitable accommodations that'll fit your lifestyle and kids. I had a friend named Bill. The day after his 40th birthday, his wife of 19 years dropped the news she was filing for divorce. She said she found out about an extramarital affair that Bill was having. He didn't deny the relationship. Bill had been seeing someone from work for a few months. 6 months later, Bill had his own place and partial custody of his sons. Bill couldn't just get a tiny apartment or live in an RV. His kids were accustomed to having their own room, taking vacations, and playing video games. Bill had to provide all those things for his kids on just his salary. He bought a house he couldn't afford. He furnished the home by financing furniture from Rooms to Go. Bill took a vacation with the kids and put it all on his credit card, hoping to pay it off in a few months. He didn't think his pickup truck would break down and cost him $1,500 to get fixed. By the way, the girlfriend from work broke up with him just after Bill bought the house. That relationship with the coworker cost Bill his marriage as well as an untold amount of money. When you co-sign on a loan for a friend or family member, you're taking on the responsibility for that debt. If you can't pay, you have to come up with the money. Chances are, if they need someone to co-sign, they're at a high probability of not being able to pay back the loan. Then, you'll be on the hook for the money. Typically, when you find out you owed money, interest rates have gone up and fees have been added. If you don't make good on the loan, your credit will be ruined. Actually, at that point, your credit has already been affected. And now, you won't be able to borrow money at the best interest rates. I had a buddy named Randy. His son wanted to buy a truck. The boy needed it for work as well as his hobby playing in a band. Because his son was young and just starting his first real job, he didn't have great credit. To get a lower interest rate on the truck, Randy co-signed the loan. His son was now saving $100 a month just in interest. Within 3 months, Randy's son quit his job and decided he wanted to make a go at his music career. A few months in, it was obviously he wasn't making enough money to pay the monthly bill on the loan. The boy tried to hide his money troubles from his dad. Randy found out when he got a repossession letter. If he didn't pay up on the loan and the late fees, the truck would be taken away. All the money they had paid in so far would be lost. Randy was mad. He let the truck get repossessed, thinking that would be the end of it, but it wasn't. The dealership sold the truck for a fraction of the value and then went after Randy and his son for the remaining balance. Randy got sued. His credit was damaged and he was out $25,000 plus lawyer and court fees. And he has nothing to show for it except the advice: don't co-sign on a loan, even for your son. Sure, we all want wealth within months. Yes, we want effortless money. You see videos and posts about how other people have become rich. With their proof, it feels like you could do it too. The get-rich-quick schemes are just that, schemes. Systems designed to make the creator money directly from your pocket. Do you hear of a foolproof plan where people are making money and think to yourself, I'm smarter than most people. I can use their strategy and not make the mistakes other people have made? I hate to break it to you. Other people are smarter than you and they're still losing money. I had a student named John who saw all the money he could make selling goods on Amazon. He saw an advertisement for a course from someone who made millions of dollars selling everyday household items through Amazon. He was convinced when he was offered a $1,500 discount when he signed up immediately for the $5,000 course. John put $3,500 of his parents' money up to learn from the master. Most of the new material John heard was already covered during the sales pitch. The course continued to sell additional services that would guarantee results. John followed through with the advice. He figures he had already put in $3,500. Why not make a go of his new business? He followed the advice. He found a product that sold well and got bad reviews. He found a manufacturer who could improve the product so his new product wouldn't get those same bad reviews. He got a sample made for $1,000. Happy with the product, he hired a professional photographer at $800 to take photos of what he'll sell on Amazon. The next step was to order enough of the product and have it shipped to an Amazon warehouse and put it up for sale. He spent $10,000 on that first order. His last step was to advertise. The course insisted advertising was one of the most important steps, but it was costly. John had a lot of competition. In total, John spent over $16,000 and a year and a half of work. He still has products sitting in the Amazon warehouse. Amazon is charging him $6.90 per cubic foot for storage every month. That's over $1,000 a year just to store his items. Watch out for the odd ways people hurt their finances. Some things might seem like they can't be avoided, but with the proper prep work, you can avoid costly mistakes. Before you get married, find out everything you can about your future spouse. Don't co-sign on a loan. Avoid get-rich-quick schemes. Keep 4 months of an emergency fund for the inevitable problems that will come into your life. Have enough insurance to deal with the risks you can't afford to overcome. Don't overspend on your car or house. Finally, keep your monthly expenses low, avoiding fees, avoiding loans, and avoiding overspending.